the Fed may finally be almost finished raising interest rates, but not for the reasons we wanted. Instead of cooling inflation, we got a bank run, with the promise of more if the Fed doesn't stop being so aggressive and start worrying more about bank shutdowns and seizures. These are certainly deflationary issues, and the market reacted like Jay Powell may have to be more circumspect next week. While the Dow ultimately closed down 91 points due to a late-day downdraft, S&P lost 0.15%, but the Nasdaq still jumped 0.45%, which is what you'd expect in an environment where we're less worried about rate hikes. Yet it took a fistful of bank failures and no doubt a few bank failures more to cause short-term interest rates to plummet, suggesting that the bond market believes the Fed's almost done, or might even be actually finished with tightenings. If that's true, it's ridiculously bullish, which is why we could rally so hard early in the session, even as most of those gains evaporated by the close, because that's a mighty big if, and the regional bank stocks just never stop falling, casting a pall in the entire market. And at the end of the day, it's hard for the averages to rally when First Republic's down 62%, Western Alliance is down 47%, Comerica and KeyCorp, wow, 28 and 27%, Zion's down 26%, PacWest down 21%, and First Horizon, which was supposed to be purchased not that long ago, off 20%. These actions in the stocks of the regional banks took my breath away. Some of these are storied, even stayed, and they're saying that we aren't through this mess, and it is very worrisome that they couldn't find their footing, even after the Fed unveiled last night's bazooka. Now, the Wall Street Journal is reporting this very evening that after failing to find a buyer for Silicon Valley Bank this weekend, oh, no, the regulator's going to try again, a second auction. If this one's successful, then I think the cascading regional banks will bottom. But if it falls, that's just more fuel to the flames, and these will all be lower. Now, I hope they are offering loss guarantees, or else I can't see how anyone steps up to buy Silicon Valley Bank. Yep, the collapse of SVB last week and its aftermath gave us two markets. There's the market that's still potentially vulnerable, the banks, and then there's everything else, although the else wasn't equally dispersed. So let's do this. Let's go over what's happening here to get a better sense of where we might be soon. First, last night the Fed gave regional banks that have lost money on their bond portfolios really a chance to play again, a chance to borrow against those bonds still valued at par. Wow, that would be terrific. They're going to value them like they are at par, but they're much lower. See, these banks are in trouble because the Fed raised rates so aggressively, which is why Powell's giving them an out. Banks that took extra yield risk, meaning buying 20 or 30-year bonds to make a little extra money, shouldn't be wiped out by that decision alone. They didn't buy junk. It's just not fair to crush them after the Fed itself caused their portfolios to generate losses. Silicon Valley Bank, though, that's a little different. See, they took on that long-term risk. I wish they hadn't. It was ill-advised. But more importantly, they also had a highly concentrated deposit base that was ready to flee at the first sign of trouble. It didn't matter that the bank had cultivated these venture capitalist clients for years. They got out so fast that SVB didn't even have time to do a capital raise to make up for their bond losses. On a lesser note, the government also closed Signature Bank, again because of a fear of pullouts, as well as the fear that it might be like Silvergate, another crypto-oriented bank that was shut down just last week. Yet, for most of the day, it felt like Wall Street was breathing a sigh of relief. Even a whole slug of banks appeared to be in trouble. Part of that's because the Fed expressed a commitment to keeping as many regional banks in business as they can. Now, we don't want to be like other countries, where only a few major banks control the entire market. We like consumer banks. We like regional banks. That's part of our country's imperative. Second, pending tomorrow's consumer price index number, it's natural to assume the Fed might at least wait before it puts through another rate hike. Or maybe they'll hit us with a quarter-point hike next week and then say it's it for a while. We got to get away from that debate, though, soon. And I think the action earlier today was correct before the pullback into the close. Why am I not more concerned about these bank runs, especially when First Republic, another regional bank with a suboptimal bond portfolio and a very mobile deposit base, saw its stock plummet nearly 62% today? Look, the answer is I am very concerned. I would like to be constructive about that world, but I am very concerned. I can think of a number of banks that may not need to raise capital to offset their bond losses, although they don't have to do it all at once. And I can think of a lot of them that need to raise capital. See, I'm cognizant that other banks can fail. I just think we have an alert Federal Reserve that doesn't want everyone moving their deposits to J.P. Morgan. And by the way, that is exactly what will happen if they aren't careful. That's another imperative we don't want. We don't want just J.P. Morgan to be the only bank. But I'm also aware that many stocks have been in bear market mode for ages. Every time they start to rally, the Fed says or does something that knocks them back down. So if you believe there'll be a stay of execution on the Fed's rate hikes because they're finally getting major disinflation in the form of these bank failures, you should be pretty sanguine about the overall stock market. Just a week ago, the conventional wisdom said that the Fed would tighten by 50 basis points at its next meeting. Now the chatter says 25 basis points or nothing, lest they cause more bank failures. And they definitely don't want to cause more bank failures. Not only did long-term interest rates go down, the dollar also went lower. Another real positive for much of the stock market, especially the big multinationals. Now let's put it all together. Even after the late afternoon pullback, the winners today were the multinational consumer product companies. I want you to think about companies like Procter & Gamble and J&J, two charitable trust names that remain way down from their highs that we talked about at both our morning meeting and our home stretch. Drug companies in particular should do well because failing banks are inherently deflationary, and they do better with a weaker dollar and more of a recessionary outlook. Oddly, buyers rushed into tech, too. I think that's just thoughtless buying driven by machines. You've got a lot of algorithms that buy tech whenever bond yields go down because inflation tends to be bad for tech. But because this is done by computers, they can't ask themselves, hey, maybe the demise of Silicon Valley Bank signals something negative about their industry. Remember, SVB catered to companies that haven't come public yet and the principles behind them. The bank even lent against shares of privately held startups and applications in anticipation of their IPO proceeds. That's something very few financials will do because it is so risky. But you need to know, First Republic does do the same thing, which is one of the reasons why its stock got killed today. Of course, the kind of tech stocks that roared today have no need for credit and thrive on growth alone. Apple and Microsoft have the greatest balance sheets of almost any company in the world, and they were both up nicely. We do know these tech stocks get hurt when the Fed raises interest rates. That's the story of last year. So it's reasonable to believe that they deserve to rally if the Fed is going to stop tightening. We always say don't fight the Fed around here. If it's true that they'll get less hawkish, you're no longer fighting the Fed. Smaller techs, though, like, say, a GitLab, which reported this very evening, still one more loss-making enterprise software company, reported a terrible set of numbers, and it is getting crushed. Those kinds of companies I am begging you to continue to avoid. Ultimately, I'm not oblivious to what awaits us with the banks. We saw so many regional banks get crushed today, along with Schwab, the broker, and even Citigroup, a major international bank. I'm not getting into the game of whack-a-mole, but I fear some of these banks won't be savvy enough to take advantage of what the Fed's offering them because they don't want to hurt their own stocks. Guess what? You have. It is vital that the regional banks don't break ranks. They need to get whatever relief they can, so they can fulfill their roles as lenders to local markets, small to medium-sized business people. If they don't, then more bank failures on top of all these rate hikes could push us into recession. We sure don't want to use taxpayer money to save them. Right now, that's unnecessary, as long as they're willing to work with the Fed. And that's what happened behind the scenes today. Lots of negotiations. But the bottom line, if the Fed had done nothing, if they'd been worried about moral hazard, like the possibility of Bitcoin going higher, which it did, or that rich people would do better, as they will now that SVB's depositors will be insured beyond the $250,000 FDIC limit, then we might have been looking at a full-blown recession, maybe even by the end of the week. In short, we dodged a major bullet.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.